All right, Eel Nerds, episode 122, and I am coming up on what I consider my 6 months of importance in investing and discipline. And so I thought I would share with you my 6 month investing plan between now and the election. And there I am running between the bulls and the bears in front of the New York Stock Exchange. Thank you, Dolly. Well, we're at 300 something subscribers. If you're new, please make sure that you use the playlist called the Yield and Income Investing Roadmap. And remember to check everything here. I can't predict anything any more than you. I share my education, use it as such. Well, today's episode is organized into three different parts. One is we'll go take the temperature of the market. It's pretty hot, a lot of bulls out there. Nvidia absolutely crushing it. And in the meanwhile, I thought I would play my yield Superbowl and share with you my trades. So let's see where the markets are. Well, the past month alone, the market has absolutely gone bonkers, 6% up. The NASDAQ is up 9%. The Dow is up 4.5%. And my piddly portfolio is up 0.6%. Not at all exciting. What is going on? And the reason I am kind of lagging the market is because the equity markets are on a tear, and I am sitting with the vast majority of my holdings in treasuries, and they are short-term treasuries, so I'm not participating in the action, and I'm starting to feel left out. And I do have an underlying premise, and I'm not going to jump from one thing to another overnight. My underlying premise stems from my belief that, hey, I have returns of around 6% a year. It's not shabby, and those returns are state tax free. I'd like to explore slightly higher risk between now and the election, but jump into equities after the election. I'm in no mood to jump into equities before then. And my main reason for that, unfortunately, is my lack of confidence in the ability of Americans, disagree agreeably. And as hard as that is, I am not going to take a lot of risk between now and the election. At least that is my strategy. You do you. So my personality, if it has not already become clear, is to wear helmets when I go surfing, to look at gold and say maybe it's fool's gold, and go bottom fishing. I've used all these analogies, but I've been too risk averse, and the market is handsomely rewarding people who are taking risk. And so I thought I would play Yield Super Bowl again to see where I should go. Before I proceed much further, please remember that I am not a wealth management advisor. This is not investment or tax advice, and I don't have any secret product to pitch. So please use your own judgment. Well, what is Yield Super Bowl? We take the various fixed income instruments, and then we compare their yields for the same duration, and then slowly increase duration, and we create a roadmap of where to go. And we've done it a few different times, and every time we always follow it up with, hey, some things are state tax free, some things are federal tax free. So to keep them on par, we're going to tax adjust them and compare them all on a pre-tax basis. And so when we did that, we did this 3 months ago, we saw that in the very, very short term, treasuries were really good, almost 5.25% 3 months ago. And bank CDs surprisingly made an entry in the 1 year time frame. And corporate bonds showed up in the 3 year time frame. And agencies way out. Agency bond yields had crashed 3 months ago. And so I thought I would update it and see if, I would think different. 5% yield was like the big deal. This was 3 months ago. Well, look at this. If we looked at only the treasuries over the last 1.5 to 2 years, you're going to see that we started in September with a little bit of an inverted yield curve, and that was the big topic of the day. And starting from there, if we went a year, the whole myth was, hey, there is no soft landing, there is going to be a hard landing. Look at the inversion. Oh my God, there is a really big inversion. There is no, what they call term premium, meaning holding the 10 years gives you less dividends than holding the 2 year, which is kind of insane. And that was the story in October 2023. And By February, the middle of the curve had collapsed and there was kind of a straight line going down. And what is interesting is in the last 3 months, we're worried about debt, we're worried about where this is going to go. The middle has crept up and the long tail has also crept up. And, that tells me, here's at least how I would understand it. That tells me that there is even more room to go for the long tail to come up. So I'm not increasing duration. And in the short term, I can get 5.5% pre-tax. So that's a pretty sweet deal. So once you do the tax adjustment, here is where the yield Superbowl lands today. In the very short term, meaning less than 6 months, treasuries absolutely take the prize. And agency bond yields have indeed recovered. And pretty much after 6 months, it's agencies all along. However, you got to be careful about allocation to agencies. They are not treasuries. They have affiliations with the government, but they are not the government. And also, some of the agency bonds are state tax free, others are not. So you got to be careful. My duration, as I told you, I think of this as a 6-month horizon between now and the election. I am squarely focused on the really short duration, and in that really short duration, treasuries are the name of the game. So the way I'm going to allocate is stay very heavily in treasuries, some level of agency bonds, and within fixed income I have some corporate bonds, but these are duds I have from before. But in terms of equity, I might increase my equity allocation, maybe see if I can take more risk, but not a huge amount. 5% is nothing at the end of the day in terms of your portfolio. But I, at the moment at least, only plan to buy value stocks using value filters. And I've reviewed what those filters are before. And in terms of where I want to park it, my instinct is to again go to sectors of the industry that are ignored. Food, for example. I'm a big proponent of Cal-Maine Foods. I love the business they are in. They are a very dominant player. They don't have a lot of substitutes. When it comes to energy, I like TK Tankers. I like Ardmore Shipping Corporation, and I like Cord Energy. Those are all squarely in energy in the United States. There are a couple of defensive sectors that I'm researching. I haven't landed on any yet. There may be a small exception we're going to review. And the other two that I would feel comfortable holding for a couple, 3 years would be in the pharma and defense industry. Even if there is a downturn after the election, I would feel comfortable holding pharma, defense, food, and energy. That's how I think. And so I created a defense Magnificent 7. Realized that if I keep the single Magnificent 7 across all industries, none of these defense Magnificent 7 would qualify. Now, why do I say that? You can look at the debt to equity ratio. These things have a lot of debt. I don't like anything more than a debt to equity ratio of 0.2, so they'd fall off. Their profit margins are 12 and 7 and 5. I like very healthy profit margins, 15 and above. Look at this, the price to earnings ratio in the 20s, and I am not a fan of buying any of these. These are good. These are the best of available choices if you have to own defense. I am not going to do that, at least at these prices, so I'm staying away from these stocks. Now, when I go to pharma, I did see an exception. So I went to pharma and I noticed that United Therapeutics had a 40% margin, which is very healthy, very little debt, very high cash flow. Their PE ratio is 13. I mean, it's not 3, but 13 is still not bad. And so I started wanting to understand, United Therapeutics more. And so I figured, if they are going to make it to my portfolio, they have to be able to compete with Cal-Maine Foods and TK Tankers. And now, when you purely look at how the stock does, the stock is the blue curve. It's above the S&P in terms of beating their performance. And so I started looking at a deep dive. And this is comparing 3 things in 3 different industries, to be clear. I'm only doing it because if I need to take capital that I would otherwise allocate to any of the others in my portfolio, I then want to make sure that this stacks up. So in terms of net profit margin, you can see United Therapeutics is even higher than TK Tankers. What a surprise. Then I start to look at the valuation. The earnings per share again is higher than any of the others, and now I'm starting to take notice. Now there is a problem there. Price to earnings ratio is higher than the other two. Not a fan, but 13 is not bad still. And price to sales wise, you're paying $5 for every dollar of sale here. And so overall, the earnings per share and PE ratio are healthy, and price to sales, Cal-Maine and TK Tankers are still fantastic deals. And so I started looking at growth, and this is where it kind of startled me. I can see that United Therapeutics is growing much, much faster than the other two. Their earnings per share is absolutely eclipsing the other two. So I can see why it showed up in my Magnificent 7 filter. It doesn't meet all the criteria, but the ones it meets, it is pretty impressive. And for example, their gross profit margin. Now, Pharma always has a really high gross profit margin. However, even their net profit margin is higher than TK Tankers, which says a lot. And so I started noticing, United Therapeutics as a real contender for my portfolio. And my favorite thing, debt, I noticed they didn't really have too much debt. So if you put all those together, you're going to get respect, you're going to get attention from me. And so I will tell you the trades that I made this last week. The first thing I did pick up some United Therapeutics. I know it met all of my filters, and it's defensive, so I like holding that into the election. Outside of that, everything else is not a surprise. Ardmore Shipping Company, I bought them in many different troves, TK Tankers and Cal-Maine Foods. So here's what I'm left with. This is my portfolio, a whopping 7 stocks: TK Tankers, Cal-Maine Foods, Ardmore Shipping, United Therapeutics, Chord Energy, and a couple of preferreds, and the preferreds have very small allocations. So that is where I'm putting my money. I'm going to stay in treasuries and value stocks for the next 6 months. You do you. And for the person who sent the comment saying, hey, you put a lot of music in your video, please don't put it. It's distracting. Thank you for the feedback. No music on this one. Have a good day.